we're starting to see markets turning quite significantly. I mean, looking at Asia and the fact that we saw quite a mixed performance, it seemed to have spelled perhaps a little bit of a negative day. It's got to do with the Alcoa numbers that we saw out yesterday. Although good numbers on the profit front, sales slightly disappointed.
Yes, it would have been nice if that sales side was slightly better, but they did beat the forecast, and it's a good start to the earnings season in the States. Obviously, they've taken a lot of costs out of the system, and that's why their profit numbers are coming up. Sales weren't too bad, but obviously we would like that to have increased as well. So it's a good start to the earnings season, but it could have been slightly better.
It also seems that sentiment is going to be driven, as we've said, by the Eurozone. It's got to do with Portugal, Italy and the likes of Spain. What kind of bearing is this going to have on the equity market? I mean, the local currency has been coming under pressure. We're seeing a little bit of a rebound coming through for the rand today against the US dollar.
Well, I think that on the euro debt side, the sovereign debt issues are at least propping up gold. So gold is staying firm. You see an increase in the gold price over the last few days, and so that's keeping our gold miners a little bit firmer today, and also brings back a little bit of strength into the rand as people come to buy some gold. Against the US dollar, euros at nearly at an all-time low again. So we'll be watching that trade very closely. The European sentiment actually improved over the last few days, and I think that also has to do with Japan buying some of those euro bonds. So we'll watch this very closely, but I think that the euro at these levels will probably strengthen from here onwards over the next few weeks if the sovereign debt issues subside slightly.
And Rob, which sectors are you looking at this point in time? I mean, we've got the resource 20, which significantly underperformed the industrials and financials last year. Do you see more room to move to the upside on this particular sector?
I definitely think so. I think if you take a look at the Bank of China saying that their growth rates are expected at 10%, that's good enough to keep commodities really firm over the year. They also saw their surplus diminish, and they had a lot more imports than they normally had. So that's boding well for world economy as China starts to import more and starts to develop their own economy. So very positive on that side. We saw also all of the floods in Australia currently. If you take a look, you mentioned that there was a shipment of coal out of South Africa, and you take a look at Exxaro's price. Exxaro on the 31st of December until now is up nearly 7%. So people coming in for South African coal, South African miners are doing relatively well. So I think the mining side, definitely in the short term, looking very positive for South Africa.
Let's touch on the global equity environment and how that feeds through into the JSE. Some say that on the JSE All Share we're looking slightly overbought. It really all depends on what we see from an earnings perspective. It seems the markets have priced in 15% earnings growth. Do you expect a bit of a correction coming to the fore when it comes to South African markets, or do you think that we could see some more upside?
It's a difficult call. On a PE level, a lot of the stocks are fully valued. You see the retailers, banks fully valued at the moment. But the sovereign debt issue in Europe seems to be very localized, and the risk appetite of asset managers overseas hasn't diminished into emerging markets. And I think really what you have to do is watch the flow of money. And if the flow of money still comes into emerging markets, even though a lot of these stocks are fully valued, money will carry on flowing into the exchange. So I think you have to really look at the risk appetite of the European asset managers, and if they're still looking for emerging markets, we can still see upside on our markets.
Let's touch on Shoprite. Came out with some numbers. Turnover grew by 9.5%. Looking at December sales up around 12%, and furniture seems to be one of the sectors that we saw a little bit of growth coming through as well. A gain of 4.3% for the 6 months to December. Some investors view these numbers as slightly disappointing.
Yes, I think we wanted to see a bit more growth from Shoprite. I think on the food side, they're not getting much food inflation. I think the unemployment rate in South Africa is problematic. They're dealing with the lower end of the market, and on that food side, they're starting to see some sales slip. Pick n Pay, which had a very difficult year last year, has also seemed to have got their feet stabilised and starting to take a little bit of clientele away from Shoprite. So we would have thought their numbers would be slightly better. December looked relatively good, and if that trend continues, that will be very good going forward. But overall, not as strong as the market was expecting.
That said, we are starting to see the share price doing quite well in today's session, and it's up around 1.25%.
Yes, I think it has come down from over 100, I think 103 Rand, all the way down yesterday to a very weak close in our market generally, to about 95 Rand. I think Sid Vananella, our analyst, which you'll have on a little bit later, has got a sell on Shoprite and a target price over the year of about 87 Rand. So we think it's fully priced. There will be obviously fluctuations, but on the upside you're looking at about 103 Rand. On the downside, probably 87. So right in the middle of the range at the moment. I wouldn't be a very large buyer at these levels.
Taking a look at Capital shopping centres, there's been quite a lot of noise around this company and the fact that they're interested in the Trafford acquisition as well. What is your view, given the fact that we saw a 4% drop yesterday? This company once again under pressure, and we've also heard that Simon Property has abandoned its pursuit for the British Mall. So clearly quite a lot of news, perhaps an opportunity to buy.
Yes, I think leaving the desk a minute or two ago, it was another 4% down, trading around the 40 Rand level. It hasn't been there since early November when it had a bit of a sell-off after it said it was going to bid for the Trafford shopping centres. The bid for Trafford shopping centres, they've reduced slightly. I think an 8% pullback on the stock, 39 Rand, anywhere under 40 Rand looks like good value. They are trading below their embedded value. They've got really good assets, and I think anywhere under 40 Rand is worth picking up some of Capital shopping centres. It's got a good stream of income coming through, and if you see the world economy, your view of the world economy is that it's going to be improving over the next year. I think these are quite good levels to enter.
Rob, why do you think investors have been so averse to CSC shares over the last couple of days, if the outlook perhaps looks far rosier than one might think?
I think because of the acquisition of Simon Properties, people gear up just for the corporate action. They start to take very big positions. It guarantees them, if the transaction goes through, a certain return over a month or 2 months. And when these type of deals fall away, they have to rebalance their portfolios. They'll start going maybe from overweight into neutral. They won't necessarily be selling out totally, but they'll be reducing their weight, and there comes a lot of selling pressure over a short period of time. An opportunity, if you're not in it, to pick up some stock.
Manufacturing set to be released later on today, and we're expecting a number of around 2.7% for the month of November, from around 2.5%. Of your view on the manufacturing number? It's interesting because usually we get the PMI number ahead of manufacturing, but due to the holidays, those two pieces of data have been swapped around.
Yes. With a very, very strong rand, especially at the end of last year, we're difficult to see our manufacturing number be improving beyond that. If it is, I think it'll be very positive for us if we can start to improve manufacturing with such a strong rand. But I think with that rand where it is, anything above that level will be very positive. I don't think we'll get anything better than that.